The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Ever wondered how Warren Buffett, one of the world's most successful investors, built his fortune? Imagine a young investor in Omaha quietly shaping the world of finance. Buffett's strategies weren't just about picking stocks. They were a masterclass in patience, discipline, and understanding businesses. From small beginnings to managing billions, Buffett's journey is an exploration of how strategies evolve to navigate new markets and industries. Let's dive into how Warren Buffett's investment strategies evolved, the lessons learned along the way, and how he influenced the global economy itself. 1. The early days, value investing. Our journey begins in the 1950s, where a young Warren Buffett was learning the ropes from Benjamin Graham, the father of value investing. Graham's approach focused on identifying undervalued companies whose stock prices didn't reflect their true worth, a concept Buffett embraced wholeheartedly. What was the essence of value investing for Buffett? It was all about buying $1 for 50 cents. This strategy wasn't about day-to-day market movements. Buffett sought companies with strong fundamentals, even if they were temporarily out of favor. One of Buffett's notable early investments was Berkshire Hathaway, a struggling textile company. While it may not have seemed glamorous, Buffett saw potential and value. This investment laid the foundation for what would become his empire. The early days of Buffett's career were defined by a simple principle: find value where others see risk. But it wasn't just about making smart buys. Buffett also learned patience. He wasn't looking for short-term profits. He aimed to understand the businesses and their long-term potential. In his early years, this focus on value and fundamentals set him apart from other investors, establishing the disciplined approach he would carry throughout his career. 2. The shift to quality companies. By the 1960s and 1970s, Buffett's strategy evolved. While he remained a value investor, he shifted toward acquiring high-quality companies with long-term prospects. Instead of looking for purely undervalued stocks, he sought businesses with strong economic moats, a competitive advantage that could last. How did Buffett's strategy change? He started looking for great companies at fair prices, not just cheap stocks. His partnership with Charlie Munger influenced this change. Munger argued that it was better to buy a great company at a fair price than a mediocre one at a bargain. This led to investments in companies like Coca-Cola, which had a strong global brand and consumer loyalty. Buffett invested in Coca-Cola in 1988, and it remains one of his most profitable holdings. Buffett realized the magic lay in finding companies that grew stronger year after year. During this period, Buffett's focus was not just on a company's price, but on its management, reputation, and ability to endure tough times. Coca-Cola, for example, had global reach, a strong brand identity, and a product that people loved. These factors helped Buffett identify businesses with staying power and long-term profitability. In the 1970s, Buffett wasn't just investing in stocks. He was investing in legacies. 3. The long-term approach. Buy and hold. By the 1980s, Buffett fully embraced the buy and hold strategy. Rather than trading stocks frequently, Buffett became known for his patience and willingness to hold investments for decades. Why does Buffett prefer to hold stocks for so long? Because compounding works best over time. Buffett wasn't interested in timing the market. Instead, he focused on finding businesses he could hold on to forever, allowing their value to grow over time. His investment in Coca-Cola is a prime example. Despite market ups and downs, he's held onto it for over 3 decades, reaping rewards from dividends and stock growth. For Buffett, the stock price wasn't the only factor. It was about the business's growth and cash flow. As Buffett famously said, "Our favorite holding period is forever." He wasn't chasing short-term profits, but owning great businesses for the long term. Buffett's secret weapon? Time. He knew that great investments needed years to fully blossom. His long-term approach was also applied to Berkshire Hathaway itself, which evolved from a textile company into a holding company with a vast portfolio across various industries. Today, Berkshire owns companies like GEICO, Dairy Queen, and Duracell, reflecting Buffett's approach to long-term ownership. The power of cash flow and dividends. As Buffett's empire grew, he focused more on companies with strong cash flows and consistent returns to shareholders. By the 1990s, Buffett had become a champion of dividend-paying stocks. What does Buffett love about dividends? They provide a reliable stream of income, no matter the market. Buffett appreciated companies that could generate steady cash flows and pay dividends, even in tough economic times. His investments during this period include Procter & Gamble, Johnson & Johnson, and Coca-Cola. These companies had the ability to generate cash consistently and return capital to shareholders, making them ideal long-term investments. For Buffett, cash flow and dividends were the fuel that powered his investment machine. Buffett also saw dividends as a way to reduce risk. In his eyes, a company that could regularly pay dividends had strong financial health. Moreover, dividends provided a steady stream of income that could be reinvested, further compounding returns. In the 1990s, Berkshire Hathaway's ownership of companies with strong cash flows and dividends allowed Buffett to keep building his portfolio and expanding into new sectors. His emphasis on reinvesting dividends also demonstrated his belief in maximizing long-term growth. 5. The modern era, concentrated bets and acquisitions. In recent decades, Warren Buffett's strategy has increasingly focused on making large, concentrated bets on key companies. Instead of diversifying across hundreds of stocks, Buffett now invests in fewer companies with high conviction. How did Buffett's modern strategy evolve? He started betting big on fewer companies he strongly believed in. Buffett's $26 billion acquisition of BNSF Railway in 2009 was one of the largest in Berkshire Hathaway's history. This move marked a significant shift toward acquiring entire businesses, particularly in infrastructure and transportation. BNSF has since become one of Berkshire's most profitable assets. Another key modern investment is in Apple. For years, Buffett avoided technology stocks, but in 2016, he made a massive investment in Apple, which has become one of Berkshire's largest holdings. This shows that even a legendary investor like Buffett can evolve and adapt to new sectors while staying true to his principles. Buffett's modern investments show that even legends can evolve, betting big on the future while sticking to core principles. Buffett's focus on making large, concentrated bets rather than diversifying widely has proven to be a powerful strategy. His investments in Apple and BNSF show his willingness to commit substantial capital when he sees long-term potential. Conclusion: timeless lessons from Buffett's strategy. Warren Buffett's strategies have evolved over the decades, but his core principles, finding value, understanding businesses, and investing for the long term, have remained constant. From his early value investing days under Benjamin Graham to his modern-day strategy of making concentrated bets on high-quality companies, Buffett's journey offers timeless lessons for investors. What's the key takeaway from Buffett's investment journey? Great investing is about understanding businesses, not just stocks. His ability to adapt and refine his strategies has made him one of the most successful investors in history. Buffett's success is a reminder that successful investing is about playing the long game, understanding the businesses you invest in, and having the patience to let them grow.